Welcome to the Pipnotic Symposium for the 22nd of August 2019. Today is a beautiful day in Bali. The sun is shining. There's a really nice breeze kind of moving in across the jungle here, and it's actually quite a glorious day. I'm sitting in a room that is empty, so you might hear a bit of echoing in the background, so sorry about that. I hope it's not too bad. They're doing some building on a small house next door, so there's a bit of angle grinding and hammering and painting going on over there. You probably won't hear the painting, but the other stuff you may very well hear. But I just wanted to spend a few moments to go over a couple of pairs and to start off with, maybe walk through like a typical procedure for performing an analysis. Okay, so I'm just going to get some slides up here, and this is entitled a simple yet effective way to trade supply and demand like a pro. And I say this a lot, to trade supply and demand like a pro, and this is because it is my conviction that if you follow some pretty simple rules, you'll definitely be doing very, very well. And we have a bunch of guys in the chat room who have been running around the internet from mentor to mentor, looking for a bit of insight as to how they should approach the markets. And over the course of maybe the first few months of them being within our community, things seem to turn around for them. And for this, I'm really, really pleased about. But I'm also grateful that the material that we have is useful and is capable of helping people switch on the lights at a time when things maybe seem a little dark, because I know that trading is really difficult to do. It's difficult to get right. Essentially, it's simple, but it does not mean that it's easy. It's quite difficult, and the difficult bit comes from the individual who is attempting to trade. I know a couple of people, one gentleman in particular, and successful trading eludes him something fierce, and this chap's been doing it for a very long time, and he simply cannot get his head around it, and that's very unfortunate. But we'll run through this method. I'll try to simplify it again, and then we'll apply the theory in a video. And this video I'm going to try and keep pretty short. Sorry, I threw in a Danish word there. Yes, let's get started. Okay, so the overview is identifying supply and demand. We're going to have a look at a price chart, trade entries, and then we're going to discuss some trade management. So, an introduction: trading is not rocket science. A lot of people, a lot of professionals and mentors really like to overcomplicate trading so that they can justify taking enormous sums of money for their teaching or their services or whatever, or fees or whatever it may be. But the truth is that it really is not that complex. And if it is complex, then it's difficult to do right. But if you keep things very simple, you'll find that it gets a lot easier. So removing all the indicators from your chart, focusing on recognizing specific price patterns on a price chart, and I think you'll be doing very, very well. And we have some software that's available via Pipnotic subscriptions that I don't think many of you are using, but I'm going to show that today. I think you'll find that it'll knock your socks off when you have a look at it. Okay, here we've been through this. The process of trading should be simple. Okay, it doesn't mean it's easy, but it should certainly be simple. So you should easily be able to navigate your way from steps 1 to N to essentially figure out if you should be entering a trade on a specific asset and if you should be buying it or selling it. Okay, it should be simple, but that does not mean that it's going to be easy. And so here we have, as I mentioned previously, the greatest challenge we have as a trader is dealing with ourselves. And this is essentially because of fear-driven behavior, the fear of missing out. So you get into trades when the risk is the highest, the fear of taking a loss, or and so you're interfering with the process. And so you get into a trade, it starts to go into profit just a little bit, and the fear of that trade, that once good trade, going negative, is growing so quickly within you that you click out at a very small profit. And that's something as well that I think many people struggle with. Okay, so how do we identify supply and demand? We've gone through this hundreds of times throughout the years via all the symposiums that we've done, but we can boil it down. There are three different ways that you can do it. One includes currency strength that we won't look at today. And then we have these two here. We have the consumption of opposing supply and demand. And then we have what I like to call as market structure failure. Market structure failure. And here we refer to trend lines, because we use trend lines enable us to slice, rather to make sense of what the price of an asset is doing. And so you can use trend lines, upward sloping, or flat trend lines, enable to help us kind of see historically respected levels for a given asset. This is very important, okay? But this one and this one, they work together. This one is good, this is fine, this is the main rule. And this one, of course, we can have market structure fail, but at the same time we want opposing supply or demand to be consumed. This is really important because we don't have valid volume information in the retail FX space, and this is because the market is highly decentralized. We have the primary liquidity providers like Goldman Sachs and Credit Suisse and JP Morgan and all the other big banks, and they are selling liquidity to intermediaries like the brokers that we're engaging with. And so depending on what the broker does with the data or how many customers the broker has, I mean, the information related to volume and sentiment is going to vary from broker to broker. If you have a bunch of people who use platform A, and platform A is retail space, and let's say 95% of these people are losing, then volume is going to be unusable for the trader who is looking to be profitable. Essentially, he'd be having to trade contrary to what all the information his broker is providing him with in order to earn money. Okay, good. Okay, so we have a couple of different ways to do it. We have the full analysis, which I prefer. This is more thorough, and then we have a quick analysis. And the full analysis is starting on your longer term time frame, and the quick one is just moving through a number of very quick steps so that we can make some quick trading decisions. Sometimes I'll do it quickly, but most of the time, especially for my longer term trades, I like to do a full analysis, because this is going to tell me where the major flows are. We're going to see what is driving price historically, and so this is going to enable us to make much better trading decisions in contrast to looking at one time frame and trying to figure out what's going to happen next. Okay, and so we'll cover these shortly. So analyzing a pair chart, this is what you want to do if you are considering the full procedure, which I highly recommend. This is, I mean, you shouldn't even be looking at the quick shortcut. Essentially, the quick is a shortcut. Okay, you don't have an hour to spend at your charts each day. You only have 15 minutes. What are you going to do? You're going to reduce the number of assets you trade, and you're going to do the analysis quickly. Okay, so this is why I made the process quicker. The full analysis is if you have a proper amount of time. Let's say 1 hour a day. I mean, I can analyze all 28 currency pairs, so crosses of all the 8 most traded currencies, and this takes me maximum 1 hour. Normally I'm done within half an hour, and then I reiterate. Because sometimes when you go through the other pairs, you'll notice things on, for example, the dollar index or the dollar Swiss franc or commodity currencies that will affect the way you'll trade a symbol or an asset that you previously looked at. And so this information I like to bring back when I'm doing my second iteration. Okay, so first of all, you have to pick your style. Your longer term, your shorter term, or your short term. I like longer term stuff because the noise that is present in the intraday volatility is not there, and so you have this really nice smooth movement of price which starts to emerge from about the 4 hour chart and up. If you go below the 4 hour chart, the 1 hour, the half an hour, the 15 minute, the 5 minute, the 2 minute, the 1 minute, then things get really volatile, and this is due to, well, essentially volatility is a function of liquidity. And so if you're looking at an illiquid asset, then the volatility is going to be higher. Why? Because price will have to move, the market will have to move higher and lower in order to find the liquidity that is going to be sufficient to stop it and move it in the opposite direction. Okay, good. So we have the long term, medium term, short term. We do our top down analysis, and here we mark all our long and medium and short term supply and demand. We define market structure. I'll just draw it there via trend lines. Okay. And this is a little bit more subjective, but maybe not that bad at all. Obviously, everything is subjective. There's a very high degree of subjectivity in most things, because it's going to affect rather historical experiences, and skill is obviously going to affect what you're doing, how you're doing most things. So if we have a quick look, okay, you know what? Before we go into the quick, let's have a quick look at the full on a chart. So let's have a quick look here. Let's assume now that the long-term time frame for us is the weekly chart. And so we want to look on the weekly chart, and we want to ask ourselves what is driving price. And you can see that currently the most recent area that has been tested is this monthly supply here. And I mean, there's nothing below here. Let me enable the stuff that is on this time frame as well, so we'll see the weekly areas. Okay, so we have a little area just down here. This little area was established. Price is approaching this area of weekly demand here. What does that mean? That means that we have the origin of this move. Okay, price moved up into opposing supply, and now it's giving back these gains here. Okay, so price is moving back to the origin of this move. So if we have a quick look what that looks like, so we have the origin is here, price moved up here, this is the high, and now price is returning to the origin. And this is really important, and this is because when price came down to this level here, it shot up really quickly, and it did not look back for many months. It just kept going higher and higher and higher. What is that telling us? Well, that's telling us that below this line here, there's a very keen interest on buying the euro American dollar. Okay, this is a price level that institutions, organizations that are looking to liquidate assets that are beneficial for the euro American dollar being long are focusing on price window that is below this here. Okay, so this is really important. We also have a high here, which is also important. Why is this important? Well, this is important because last time price got up to these highs here, there was enough selling here to move it lower. What does that tell us? Well, that tells us that until price reaches the beginning of the buy zone, and what is the beginning of the buy zone? The beginning of the buy zone is a price window that is going to tell us where we have an attractive price for a specific asset. And for this asset, you can see the beginning of the buy zone starts just here. You can't really see it because my circle there, but it starts just around here. Okay, we had this one here, which is really interesting. It's been tested. What does that mean? That means once it's been tested, you look lower. We have another one down here, but this one is troublesome because there's a gap. So we had this week ended, it stopped here, and it gapped up to here. So there's something in here that is telling us there was a keen interest on moving price, because prices between the open of this and the close of this were not being quoted. Price had to move higher to find buyers. What does that mean? That means price is looking to move higher. People are willing to pay higher prices, or they were looking to pay higher prices for the euro American dollar just here. Okay, because normally in order to find buyers, you have to drive price lower. In order to find sellers, you have to drive price higher, but not here. Okay, people are willing to pay not lower prices but higher prices for the euro American dollar, which is why we had a gap high. That's essentially what a gap is. Okay, and it could also be a result of some liquidity issues between the liquidity provider and the broker. I mean, there are many parameters that dictate why a gap can happen. But when you're on the time frames like this, the weekly time frame, it's normally something that you'll see across the boards, no matter the liquidity provider. We have another one just here as well. Okay, and looked, I mean, price closed here. It opened here. What happened the last time price went there? Let's have a look. See, price went up to it, it closed the gap, and then it dumped. Okay, and here we had a really big move from there. Okay, so gaps are important, especially when they happen on important time frames like this one here. Okay, so you can see the origin of the move here. We have the origin, price went higher, and then it left. What does that mean? Well, that means that we're probably going to have an interest to buy once price comes back down here. So at the 105 and below. Okay, this is an interesting price for this commodity, not commodity, for this asset. And if you look here, let's zoom in. You can see that we had a parent. This child was formed, and we had another child that was here. What does that mean? Well, that means that this is not demand. This is a reaction to this. Okay, so we have another area just below here. So you take the bar that left, this one, and the bodies, so we'll take this here. This one looks like this. Okay, and this one here, what does this one look like? This candle left, this is in the range, blah, blah, blah. Quickly, not going to go over this. And then it looks like this. So this is what we have, okay? And so once price comes up to the 10625-ish area, we're probably going to start to see people trying to get involved. And you can see this because this area was established. Price went up, we had a strong push lower. Price accumulated for only one period. And then it opened, it closed, and then it gapped up on the following Monday. Okay, and so there was a lot of buying. There was so much buying, in fact, here that, I mean, price was quoted higher. People were looking to pay, or rather were pleased to pay higher prices for this on this Monday, okay? Good, and price had a bit of a pullback, and then price just kept going north and has not been back. Okay, so that's what we have there. Additionally, we want to look for market structure. What do we have in market structure here? We can draw a trend line, so we can go from here to here, here to here, here to here. This is super normal trend line theory. Okay, just taking the major swings, you can go like this if you want, and up here. Okay, so you take the two most recent, we have this one here and this one here. Okay, and now it is when price left this last swing high, it moved below here. Okay, what does that mean? Well, that means that we can draw a trend line from this one to this one. Okay, so we'll do that as well. It's marked off, we go from here to here. That's what we have. Okay, that's what we have here. We have this little area of supply. It was tested, it held. This is important. And we have this little one here. We have a parent, we have the child that poked into it, and then price went higher. When price comes down to around this area, we're probably going to see price do something. That's also one we might want to be aware of. Okay, good. Now we go to the smaller time frame. We do the same thing over again. What's going on here? Well, we have price reacting at this daily demand. We have from this high to here. And we had this area of demand. Is this demand? Well, the market structure failed as a result of price leaving this area. It did, but it did not consume this area here that is above, which is more interesting. And so this is not an area that I would look to buy. I would expect price to move through this relatively easy. Okay, cool. Okay, so what else do we have? Well, now we have to mark off the lows. Mark off the lows, the deepest retracement. This is the beginning of the buy zone. And we'll scroll back and see what happened. Okay, you can see the price reacted on this. And so why is it interesting? Well, let me have a look. Okay, so we had this base was formed. We had high lows, and higher highs. You can see there was a really nice breakaway from here. So this is the origin. The slingshot was pulled back to this area here, and then it popped up. Okay, and this was kind of like the most recent. If you look at this here, I don't like that wick there. We're just gonna, we'll do it anyway. We'll just go like this. Okay, so it looks like that, and price almost moved through it, then it popped up, it popped through it from here. Okay, and so this is kind of the origin of the move that eventually moved through it here. So this is important for that reason. But notice we have price here. Price came back down a little bit deeper. What does that mean? That tells us that we might want to look a little bit lower. Okay, so we have something. It's going to mark off the whole area here. We have this here. Okay, price is currently here. Okay, it had a bit of a bounce. We can expect price to. We can't expect price to do anything. There is a probability that it's going to attract some buying once it starts advertising a low price down in these weekly and daily areas just here. Okay, good. I'm going to remove that because that's gone. And now we're going to go to the 4-hour chart. We do the same thing. What do you have here? Where do we have the clean? Can you see here that it becomes a little bit noisy? If you go from here to the daily, clear the 4-hour, and the noise picks up. You can see. Well, you can see here that we had. I mean, there are no clear swings here. I mean, this is like choppy. There are no clear swings here. We had price leave, accumulate, or distribute, leave, another one here, and so price had 1, 2, 3 pushes lower into this area of demand. What does that mean? Well, that gives me a little bit confidence that we might have a bit of a reaction, because this is a pretty strong move, and this is kind of unsustainable continued pushes like this, because as we talked about many times before, in order to attract buyers, sellers, we have to attract higher prices, so that people are going to begin to look to sell, position themselves short, or get out of their long positions. Okay, but notice here that price came down here. We were there for a very short period of time, and then it shot up, accumulated, and went all the way up here. And this is where we had price moving sideways. We're accumulating orders to move price lower, and then we move back down into here. And now we're kind of moving around. And notice that we have this little piece here. Got to zoom in a little bit. Okay, this candle left. Is this an accumulation? No. Is the body of this one in the range of the previous? No. So we're probably looking at something like that. We can adjust on the smaller time frames. But notice that we had market structure that failed, and the failure occurred. Well, it occurred here initially. This is where it came from. Okay, and now that's gone. What area took it out? This one did here. So we move this to here. Left accumulation, yes, no. So this area is like that. This is where we are. This is the next area that we can expect price to react at. Why? Because this was responsible for consuming this demand, which caused market structure to fail and consumed this supply just here. Okay, so that's what we have there. So we have that there. What else do we have? And we have this one down here. We still have this low marked off. Let's see if we can have a look over here historically at what happened in the move from the origin. So we'll zoom back. We'll move back. Let's see if I have enough data. Where is it? There it is. Okay, so this is what we have here. Okay. So price has been here, reacted there. And what do we have here? Well, we have. So we have price moving sideways here. Is this a good area? No. Why? Because price has been trading in this area many times before. What does that mean? That means look lower. I want to be below here. What about this? Is this a good area? No, price has been here before. What about this? Now, this is an interesting area. Okay, price was kind of moving sideways, and it kind of moved sideways, went up, pulled back, moved sideways, went up, accumulated, and then it popped up. And the gap occurs as a result of price moving down into this area. So here we have an interest in buying come on, around here. Okay, it's a really small area. It's not that small, we're on the 4-hour chart. Let's see how big it is. It is, okay, it's 20 pips, it's pretty tiny. So we can just mark off the whole area, or mark off this here, so we have both of them, this one and this one. Price popped up, we came down, we tested, we moved up, rally accumulated. So this is actually a continuation pattern. So I think that we have, and this is also the edge of this weekly demand, and it's located just at the bottom, towards the bottom of this chart. Okay, so now we have a few areas to watch, don't we? So we have the ones that we've allocated there, and we have this one above price. Okay, and so this is interesting. This would be interesting to see what happens when price comes in here. So price could poke into here, and then we could slowly start to drift lower. And this is important because price is reactive on this weekly supply, and there's nothing that substantial below. And so, technically speaking, the Euro USD should continue to move lower. Okay, isn't this weird? Because the Fed is cutting rates and talking about doing it more, but the strength of the dollar is not going down. That's a warning sign, a serious warning sign. Good. So now price is doing that. Okay. So now we have this area to watch. We have this area to watch, and we have a couple of areas to watch back here. Okay. And this is how you do a complete analysis of an asset. Okay. This is what we've just done here. And notice we can actually see on this time frame, the clarity just jumps out at you. So you have this area that we're looking at. Has price traded these levels before? It has. Has it been at this level before? It has here. But notice that the really nice area the price has not really been down to is just here. I really like this one right there. That's a really interesting area there. And this is because, price has not been down there. This is the all-time low. Price poked down, we moved up, accumulated, popped up. We had the slingshot pull back. We didn't quite get there, and then it left, and it has not been back since. Price has been back here. It's been back here. Okay, and so each time price returns to an area, you put the beginning of your buy zone lower. So, out of all of these areas, this is the one that I would bet most heavily on. So that's what it is. You have to find the entries with the highest probabilities and pass on the ones that are lower probability. I've been using quite a long period of time on finding this, but with practice this stuff gets very, very quick. Okay, cool. So we'll delete everything. I'm just going to leave it like that. And now we are, oops, let me see, I've got the wrong version of the indicator on. I just updated all of the software. So, wrong button, this one here. And I'm still implementing the updates. So here we have this one here. Let's put in 0, 1, 2. We'll leave it at that. That's fine. Okay, good. So that's what we have there. So let's try our analysis using the quick method and see if we can find it. But first of all, let's have a look at the quick method. Here's a quick method. So you pick a pair. We've done that. You go to your entry time frame. Let's say it's the 4-hour chart. Zoom out all the way, and then ask yourself the question: is price going up or is it going down? If it's going down, you have to sell or you have to buy lower. Look for a candle that has departed an area of supply demand with strength. We can use the indicator for this. Identify an area of accumulation, draw your area, place your entry, stop, and target. Now, that sounds pretty easy, doesn't it? So let's just do those things very quickly. First of all, we're going to cheat and have the software do these things for us. We'll say put accumulation candles and extended range. So now we can see them. So now we zoom out all the way, boom, boom, like that. You can see that's a little bit too much. So what's going on? Well, we can see this push higher here. And if you look here, you can see that we have these. Before I do anything, Let's follow the rules. Is price going up or is it going down? If you could, a moving average, it would probably do something like this. Okay, is that going up or is that going down? It's pretty clearly going down. Good. What does that mean? That means we're selling. Okay, so we have a direction. Look at an extended range candle. So where do we have an extended range candle? We can just look at bleeding edge price. We have this one. We have this one. We have this one. So we have three. Which one do we choose? Okay, has price been back to this area before? It has. Where? Here, once and twice. So this is washed out. There's nothing here. Okay, the next one is here. Has price been back to this area before? It hasn't. That's it. Price traded through it cleanly, and then we move through it very clean. So this is fresh supply. Okay, so we go back to the slide. We found this, the extended range candle, the price imbalance, identify the area of accumulation, which we've done, and then we draw it. So let's zoom in. Accumulation, accumulation, not accumulation. The body of this is in the range of the previous, the body of this is in the range of the previous, the body of this is not in the range of the previous. Okay, what does that mean? Well, that means that the area goes from here, from the high of the area of supply to the lowest side of the body, which is either this one or this one. So we'll just mark it off like that. So this is the area of that we are interested in looking at. Okay. Draw area, we've done that. Place entry, stop, and target. We won't do that. But something I want to show you which is really important, and that is where is the edge of the sell zone. Okay, this is really important. So you look at the candle to the left, the candle that closed below this area of accumulation, horizontal trend line, and you mark the high of it. That's right there. So this is the edge of the sell zone. So what I normally do is I normally adjust so that it goes from here, from the high to here, and I'll put it up maybe twice the size like that. So this is the area that I would look to sell. Okay, just for fun, we'll put this on. Let's say 9. Four. Put that on. At price 11.1144. Stop. 11.70. Why didn't you guys say anything? The target. That's fine. I would say go for it. Put it there. So we'll leave it at that. We'll put it like that for the time being. Okay. That's what we have there. So that's how you do it. Simple. Then you move to the next pair. That's a pretty simple method there, as you can see. Okay, good. So let's continue moving on. Okay, so trade entries. Trade entries should be just below or above the area of supply or demand. When you're buying, you have to worry about spreads, so you have to include the spread. Sometimes I don't include the spread because I just want price to come to me, and I miss out on quite a few trades. I missed out on an Aussie Swiss franc trade the other day. It missed my entry by a pip, which is probably the result of the spread. But that's fine. And then stops, you put like plus or minus the top edge of the area of supply or demand. I normally, depending on the size of the area of supply, as you just saw in the previous example, it was a 4-hour area of supply, and I just made the stop 2 times that size. Okay, then I have like a bit of a buffer. Then you know the price has to move into uncharted waters, into the beginning of another sell zone, where there's probably going to be interested and willing sellers at these price windows. Targets require an analysis of the move up and down, and this is very true. And so we have to analyze price below. We have this area of demand, so we mark that off. We'll just mark off the whole area. It looks like that. So assuming that we were going to take that, I mean there's nothing in here. There's no supply here until here, and there's no demand until down here. Something here is very important, and that is I would prefer the price reach my entry before it reaches this demand. Why is that? That's because I know that once price comes down here or below, then we're going to attract some more buying. So I don't want that. I want the buyers to come into the market when I'm looking to sell. Okay, so you have to think, you ask yourself the question, okay, who is likely on the other side of my trade? If price moves, does not come here, if it moves from here up into my area of supply and then moves down, I'm selling, and I'm going to be selling to buyers. They're going to be down here. These are probably going to be bigger buyers or retail traders that are waiting to buy at and sell at extreme prices. Okay, and so this would be a really nice area to get out of the trade. So it would maybe look like this, something like that. I'd probably put it something like this. Why here? Because price left. We have some wicks. This is like micro slingshots. Price went up here, pulled back, shot up, pulled back, shot up, blah, blah, blah. And so I want to look at the lows here. This would be interesting for me. This is pretty decent. I think we have 25 pip stop, and the target is going to be about 75. So about 3 times the size of the entry. Okay, so that's what we're looking at there. Trade management. Well, this will manage from person to person. Some people like to get out risk immediately. They like to move their stops to break even. They like to scale out. This is really independent. Okay, this is really independent. What I like to do sometimes is, actually, this I can't say sometimes what I like to do normally because it changes. Yeah, many times I will scale in, and so I'll have my position. Let's say we have a position that's one lot, and so I will get in at 3 different price levels. So I'll divide that into 33 mini lots. Then I'll trade 33 mini lots at each at a more attractive price. Okay, and so what does this do? Well, this brings my stop further away from my entry for the more conservative entries, and it enables the targets of the first positions to fund the stop on my remaining positions. And this is just a nice way to ensure that your loss or potential loss on the trade is paid for. Okay, so this is a really good way to deal with that. Okay, yeah, when the first stop is hit, the stop or the risk on the second half. Okay, I didn't even look at this line. This is essentially what I just said. Okay, cool. So conclusion. So first of all, you have to discover how you like to trade. Some people have a horrible time sitting on their hands and waiting, looking at the daily and the weekly chart. Okay, this is entirely up to you. I have absolutely no objections about putting my orders in, checking the charts an hour a day, and then walking away. I still get to look at the charts 1 hour a day, often more, but I free up my time because essentially trading is not about working harder, it's about working smarter. So you make your money work for you. So you've earned a bit of money, you invested in the forex market, and this is where the shift between selling your time is replaced with the move into selling the value that you are able to create. The value that you're able to create is equal to the profits that your trades result in. So you're not getting paid for the time that you spend looking at a chart. You're not going to earn money. And for some people, this is terrible. This is really difficult. And if you're used to working a 9-to-5 job, and you step out of that world and you move into the trading world, people feel like they have to get paid. Man, I've sat here for 5 hours today. I want to get paid. So they'll find themselves clicking into trades just to make them feel as if they are working. This is really dangerous. Why? Because those trades often lose, because they are typically taken with much higher risk, much greater risk than the trades when you wait for price to move to your entry, like we've shown a couple of examples of here. Okay, so it's really important that you understand this. Okay, so it's good to just limit it to an hour or limit it to 45 minutes or half an hour, whatever, so you're forced to do it and then close the computer and then move away. Okay, take care and perform your analysis carefully. Okay, try not to take a personal stance on what you're seeing. If you have a trade that's open on a position, you've bought or sold an asset and you're reanalyzing the chart, do not let the result of your current trade color the way you should actually view the market. View the market as if you're not in it and you have no emotional investment in the market. Okay, so if you're in a position and you're up a little bit or you're down a little bit, maybe this will affect your decision making process when you have to analyze a chart afresh. Be super careful about this. Okay, do what the chart is telling you, not what you want the chart to tell you. And this is a really good one. If things look messy, choose something else. If you're looking at a price chart and it's simply not speaking to you, then leave it alone. Move to something else. There are tons of different currency crosses that you can trade. There are indices, there are soft commodities, hard commodities, there are futures, there are stocks. You can trade so many different things. So why force anything? Okay, this takes practice, but I think that with time you'll get better at it. Then when you do this, you'll get a very clear understanding and a very clear concept of what it is you're looking for, and then you'll be able to spot it easier. If you're forcing it, then the fuzz will remain in your head when you're analyzing a chart. Okay, and so just try and step away from that. What we looked at just a second ago, that 4-hour entry, that was super clear. Will it work? We have absolutely no idea. We don't have any expectations for it to work. We don't have any expectations for it to win. But what we are doing is that we're putting the probabilities in our favor by performing our analysis. This is the only thing that we can do. Who knows? Maybe a politician, Trump, or something in Europe will happen that will push either the dollar or the euro in one direction with high volatility. Yeah, that could be to our advantage, but that could also mean that we lose the trade. And this is when risk management comes in. If you're not using stops, that's fine, but then you have to be accounting for your risk some other way by hedging or doing something else. Simply putting in trades. Okay, let's go back to the charts. Simply putting this trade in and not having a stop, and then price comes down here, we feed into here. You still have a belief that this area is going to hold, and then price comes in here, you don't have a stop, price continues to move higher. Okay, let's say it moves higher, it moves up into here, and it kind of moves up to where your stop was, and then it contends with this, and then all of a sudden it pops through. What's the problem with that? That's no good. Why is it no good? First of all, there's no supply here. Number one, we have a fresh area of demand that consumed this supply. Okay, what does that mean? That means the market's going to go higher. Okay, what does that mean? That means you want to get the hell out of the trade. You don't want to pray, you don't want to hope, because hoping and praying doesn't do anything. Okay, I'm not a nihilist. Okay, hoping doesn't do anything. Praying can sometimes help. Hey, I live in Bali. There's a lot of praying there, a lot of ceremonies going on. And from what I can see, the Balinese seem to be able to move mountains. And so I'll say that the praying still does something. So I'll leave praying out, okay? I'll just say hoping will do nothing, okay? So just be really careful. Be willing to accept when you're wrong. Say, okay, I'm willing to put $1 into the marketplace, okay? The $1 being taken from me if we move through my stop, and the potential to earn $3 if price goes down here. Be willing to accept a loss of $1 if you're wrong, because believe me, if price does this, price will go beyond here. Okay, yes, we had an increase in selling pressure here. We have the beginning of the sell zone here, but this is speculation. And you know what? You're making from this point on, the point that you welcome additional risk into your trade that you had not planned for, everything changes, because you are no longer viewing the market with a fresh pair of eyes. Now you have emotion, you have capital invested in the market, you have an interest in the market doing something in particular. Okay, and so the neutrality of analyzing a chart has gone out the window. So you cannot do that. You have to be so careful. So take your loss, cry about it, whatever you want to do, just take it and move on. Okay, best thing to do. I take losses all the time. All the time I take losses, and it's fine. You have to do that. That's the expense of being able to trade. Okay, someone who races for a living, someone who races cars. The expense of racing a car is that the car wears. The tires on the car wear out. What do you have to do? You have to change them. Pistons wear out, piston rings, springs, valves, cables, hydraulics, everything wears in a car when it's being raced. That's simply what it costs to race a car. The same applies to this. Losses are an inevitable part of trading. Just be okay with it, okay? Just be okay with them. Just ensure that the losses you take are not eating away at your psychological capital, which is probably the most important part of your trading capital, okay? Cool. I think we covered enough information. We've also gone on for 3/4 of an hour. But yeah, if you have any questions, please post them in the forum. If you like what you're seeing in this video, there's tons of this stuff coming out all the time. So simply subscribe to the channel somewhere on the YouTube page, and then you'll get updates to upcoming material like this. We do a lot of different things at Pipnotic. We recently launched an algorithmic trader again, and it's running live, and the results available for everyone to see. That's a pretty fascinating project, and we've done it on a very small account. And this is because most people who enter the retail FX arena, they normally come with about $1,000, $2,000, $5,000. So we've actually put the robot on $1,000, and we want to see how it does. See if we can take that $1,000 and grow it to something, and learn along the way. So the money's out there. I don't care what happens with it. I can lose it. That's fine. It's just an experiment to see what we can do, how we can, if we can, automate supply and demand trading. And so far, things are going pretty good. This is the account running at the moment. It's been running for a couple of days. We're about 3%. We have some positions open, so things are cruising along nicely. Okay, so yeah, it's an exciting experiment. I think it's very fascinating to experiment with algorithmic trading based on the discretionary tools that we have in our arsenal at Pipnotic. I forgot to mention there's a tool that many of the members have that maybe you guys don't know about, so I just want to show that very quickly. And this tool is called Kendals. And this is a really cool tool, a really cool tool, and I'll show you exactly why. Okay, if I'm looking at this price chart here, this is a 4-hour price chart. These are 4-hour candles, but I can see weekly candles on top of those. Okay, so I mean, look how awesome this is. We had this tiny little pin bar here. So we had a weekly doji, price rallied, moved sideways, then it sold off. Nice area to sell here. Price came down, we accumulated for 2 periods, then we cut away. Price came back and poked into the accumulation, and then price left. Isn't this cool? And so here you can actually see, okay, where's the beginning of the sell zone? Okay, well, you can see here, look up, you can see here we had a top, price came down, accumulated, we have the parent, we have the child. What do? You move up to the parent, which is about here. Okay, price went through the parent a little bit further, and this is where we found the sellers. You can see this very clearly by a big rejection, and then price broke down and moved lower. Okay, so this is a really interesting tool, and one that you have available too, so I really recommend that you have a closer look at it. If we have a look here, you can see here we're on the hourly chart, but here you can see we have 1, 2, 3, 4, 5 days of accumulation. What does that mean? Well, that means that we have a top here, price rallied, we have some spinning tops, and then price moved away. This is really interesting information to have. Notice here, if we move a little bit over, you can see the price came down. We had daily selling off. We had a doji, a pin bar to the downside, accumulation. The body of this is not within the range of the previous. What does that mean? Well, that means that the entry on the daily would look like this. Okay. No, I don't have that enabled. We'll go like that. See, look where price came to. Price poked into it. We found the beginning of the sell zone. The slingshot was pulled back here. That's exactly where price came to. Exactly where price came to. Okay, so the tools are there. Use them. They want to be used. Okay, and they work really well. Let's have another quick look at one more example. Let's have a look at the dollar Japanese yen. Let's have a look here. We'll have a look here. This is really interesting to us. Price moved down, we accumulated, and price popped up. It popped up. What does that mean? Now, that means that we have a really fresh accumulation just here. What does that mean? Well, that means that we maybe want to look to start to buy from this price level here. The beginning of the, I don't have the indicator enabled. The beginning of the buy zone is here. So we'll actually be moving away below this area, which was strong enough to hold price. Not very nicely, but price will be coming below that and moving into this area. And look at the close. I mean, this daily candle closed above all of the other closes and opens of these accumulation candles here. So this is a really strong area here. We have a look up here. We have something similar going on here. How we had price moving higher. We're ignoring it. Something up here. We're moving higher. We have a candle, another accumulation here. Price pushed up and then dumped. What does that mean? Is the body of this in the range of the previous? Yes, 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 yes. That means that we have an entry that looks like that, and the stop is up here. Okay, pretty close to where the software is telling us where to sell. Okay, super fascinating stuff. So have a look at this stuff. It's there. It's available to you, and use it. I really encourage you to use it. Cool. Well, I'll leave it at that. If you have any questions, you can send them to me in the chat room, or you can post a comment in the video below. If you like this, once again, please subscribe so you get updates in the future. And I'll leave it at that. Have a super day. Thanks for watching.